Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Cho, and I'm going to basically split this video into two pieces. The first piece, I am going to talk about basic Forex, the dollar, and what's going on in Capitol Hill, along with the stock market. So, plain and simple, let's go ahead and review a lot of information and get a lot of stuff off our chests. First off, US dollar index is rallying quite a bit, and I'm going to explain the logic behind it in a little while, but basically you're seeing a humongous rally in the US dollar index. It could lead into a short-term double topping pattern. I'm not exactly sure. You are seeing an intraday swing to the upside, and that's pretty interesting because there's a lot of good reasons for why that is happening as of right now. Moving on, the Euro-US dollar is breaking down significantly as well, and if it were me, I would definitely look to buy the 200-day moving average. Until I see a small piercing of the 200-day moving average, I won't consider a bid on that. Now, I won't consider making a bid on the Euro-US dollar pair. So let's examine the psychological aspects of this trade. First of all, 200-day moving average. You know, every single time you hit a 200-day moving average, it is a very great opportunity to consider a one-day bounce off it, or intraday bounce. I mean, at the very least, whenever a 200-day moving average is hit, intraday you will get like a 30, maybe 40, maybe even a 60 to 80 pip bounce off of it usually. Now, after that, sometimes, you know, in extreme cases, like the one back in 2008, right? You know, you might have a humongous rip straight through it. But even then, intraday, you'll probably see maybe a 30, maybe 40 pip bounce before it just continues to crash down. In our case, will we see something similar to that? I'm not exactly sure. But what I am sure of is I'm going to look for a trade 20 to 30 pips right below the 200-day moving average. You always want to buy the first touch of the 200-day moving average, or any moving average for that matter. See the 2050? First touch of it. It went down a lot, but then it came right back up. So you want to buy into it. After you see a break of it, you see maybe 20, 30 pip decline from it, and then you might want to consider buying into it a little bit for a significant bounce to the upside. So again, that's just my opinion on it. If I wanted to make a trade, I would buy the 200-day moving average on the daily chart. Okay. Now, moving on, I want to go ahead and review some key points, and that's basically the bond market and what's going on here. First of all, why is the Euro-US dollar falling down so much? Why is the dollar index going up so much? And why are bonds still being bought? Yeah, this is the December futures 2011 bond future contracts, and it kind of makes you think, with the U.S. government about to default, why in the world are we buying bonds? I mean, why are they going up in value? I mean, you know, we're facing an honest threat of having our credit rating being downgraded. Why are bonds going up in value? Well, let me just state that for around 2 months now, Timothy Geithner has not been able to borrow more money. In fact, what we've actually done is we've taken away from Medicare. They're even going as far as not paying out their own tax returns or late done tax returns. They're doing a lot of stuff right now because they can't pay out any money because they don't have any money. They're happy to receive money, of course, but they're not happy to pay out money in any form, way, shape. You know, basically they're not happy enough. They're not in any way able to pay out any money in any shape, way, or form. So what's going on here is that U.S. government is in deep crap, and the thing is that since Timothy Geithner has been taking money from alternative sources and not borrowing more money, you've seen bond prices go up mainly because of the fact that people have demand for bonds, but there's not a consistent supply of them coming into the market. It used to be that the U.S. government would constantly issue bonds to stay ahead of their obligations. But right now, since they're not issuing any bonds, the value of these bonds are going up and the interest rates paid are going down. It's just simple supply and demand. Demand is making the value of the bonds go up, therefore the coupon interest rates are going down. Meanwhile, the supply side, the U.S. government isn't borrowing any more money. So over the short term, you're seeing a short-term bounce in the bond market. Now, once the U.S. government comes back and starts borrowing money again, and the limit has been raised, or the debt limit has been raised, lo and behold, you'll see a sell-off in bonds. Now, another thing I do want to point out is this: if in the case, the U.S. government or the people on Capitol Hill failed to come to an agreement before the beginning of August 1st, and Congress have done some stupid things in the past. So it would not surprise me at all if they don't take Timothy Geithner's grave warnings very seriously. Because if they don't take it seriously and they push beyond August 1st, like the idiots on Capitol Hill can possibly do, I mean, they've done it before, but I'll talk about that later. If they do fail to come into an agreement, S&P, Moody's, they're all going to downgrade our debt. What happens then? Well, that means that we're partially defaulted, and the interest rates will go up exponentially, not just on bonds. You're going to see corporate bond interest rates go up. You're going to see the interest rate on a credit card go up. You're going to see the interest rate on just about any form of credit go up. And that's going to cause deflation and rapid deflation. What would happen in a case of rapid deflation? Well, the economy contracts, bad for stocks. In a state of deflation, you would also basically hoard your money, and you're going to have interest rates go up. The thing is that when interest rates go up, the amount of money expanding goes down. And that's kind of the whole entire money multiplier effect. You got to understand is that banks are unable to lend money at higher interest rates. The higher the interest rate goes, the more unaffordable a loan becomes. And, if loans go from 5% interest on mortgages all the way up to 7 to 8% out of the blue for people with high credit ratings, you're going to see a huge contraction in lending. You're going to see a huge contraction in the money multiplier effect, therefore rapid deflation. Now, with rapid deflation, that's bad for stocks, and that's very good for the US dollar. That's why when I pull back to the US dollar chart, you're seeing a humongous, and I mean a humongous rally. Therefore, you're also seeing a humongous sell-off in the Euro-US dollar, and now, it's getting awfully close to that 200-day moving average. I'm awfully interested in it, in fact. But blasted, it's only 19 pips away. But the point here is that you're seeing the dollar index go up drastically. And the thing is that contrary to some stupid belief that's being preached out there by people that are considered gurus when they shouldn't even be gurus, but basically, some of the generally accepted belief is that some of the beliefs out there states that if the bond market were to pull back, or let's say the government were to default, people would lose confidence in the dollar. Wrong, 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 wrong. Why? Because if the government doesn't, figure out a way to pay off its obligations, that's default. Now let's assume the government isn't able to borrow money legally, okay? And all of a sudden they're not able to pay off a bunch of their obligations. They can't pay off their workers. They can't do this. They can't do that. Government ceased to function, okay? But that would lead to also a collapse in the banking system as well. And, that would be a trickle-down effect of it. And interest rates would just go up crazily. And you'd see, U.S. government defaults, you're going to see a lot of problems, basically. And, U.S. government default means that bonds aren't being able to be paid off, therefore hyperdeflation. Hyperdeflation leads to a hoarding of money. Now, let's say you hoard dollars, okay? The only dollars that would matter are not the ones in your bank account, but what you honestly have, the paper dollar bills. That's what would reign king in a hyperdeflationary environment. Not necessarily silver, gold, maybe. But gold is a very hard item to quantify and determine its value in a hyperdeflationary environment. That's why I don't like it. I'd much rather have paper dollar bills in my house stashed away somewhere, because number one, it's not as hard to store, and number two, I'm pretty sure people would trust a Benjamin Franklin over a gold coin or a gold bar. Because number one problem, people can't tell whether or not your gold is legitimate or not. Number two, silver, same story, except silver looks like steel, therefore steel is not really trusted as much either. It could be a shiny piece of metal to them, but they can't tell the difference between silver or some imitation junk. Nobody knows. Therefore, gold and silver are kind of bad in a hyper-deflationary environment. Yes, they hold a lot of value. Yes, it could be considered a lot. And if you take it to somebody that honestly knows what they're doing, that you could convert it into US dollars and everything. But I'd much rather trust the Benjamin Franklin than I could silver and gold, especially if the economy were to suddenly deflate extremely fast in a short period of time because of what the US government is doing right now. Now, the likelihood of the US government not coming to an agreement, it's there. And you would see an immediate effect, and then they would come back and say, hey, okay, sorry guys, we're going to raise the debt limit and we're going to put it up to 25 trillion bucks. Wow. So they're going to increase the debt limit by $15 trillion, and S&P will still keep their downgrade. And yeah, that's still going to lead to higher interest rates, and that's going to damage the US economy for the long term. So again, I just want to keep that in mind for you, and let's go ahead and move on to part 2 of this video.